Hello and welcome to Switzer. I'm Paul Rickard, filling in for Peter Switzer. Well, it might be a pretty quiet market at the moment, but a lot of things coming up, in particular things like the Macquarie conference, the completion of US reporting season, our inflation number on Wednesday, and of course, just a week or so away are the results for 4 of the 5 major banks in ANZ, Westpac, National Australia Bank and Macquarie. So today on our program, our first guest, Jun Bei Liu from Tribeca, talks about the importance of those events and what they're going to mean to our market, but also shares a couple of stocks that she particularly likes. Later on, I've got ST Wong from Prime Financial, and he's got a particularly interesting sector, the insurance sector, and likes 3 stocks from different parts of that sector, and he explains why. First up, here's Jun Bei Liu from Tribeca. Jun, thanks for joining me on the program.
Thank you for having me, as always.
Now, we've had a fairly sort of quietish market the last couple of weeks, but a lot coming up. We kick off on Wednesday with inflation. We've got coming into a lot of the major banks start to report at the first week of May. And most importantly, we've got the Macquarie conference, which I think is at the end of next week. Just for those of you, our viewers who aren't familiar with the Macquarie conference, can you tell me a little bit about how many companies present and why it's so important to the short-term direction of the market?
Of course, look, it's actually funny enough. Macquarie Conference has always been known as a downgrade conference because you know what? Because the fact it's in May and it invites a lot of retailers and consumer companies to present at this conference. I remember I think it was in 2005 when Australia had a bit of a tough economic session and everything. So May was a time when retailers need to give a bit of trading update. And I remember in 2005. Most of retailers gave a sort of downgrade because consumer was slowing down and things. So it was known since then as the downgrade conference. So so it's actually quite famous that as known as sort of a more of a trading update conference. Simply because most of the company would have seen the trading performance just before the end of the year, and then they give you a bit of an update. That's why it's super important to be part of it and to be on top of the trading updates.
So I guess the assumption that companies now sort of almost have got 4 months worth of half-year results out of 6, got a pretty good feel for how they're going and what's going to happen in May, June. So if they've got some bad news and they're outside at sort of the analyst consensus forecast, they've got to come out publicly and tell us the bad news. And that's sort of why the timing of this is so important. Is that right?
Yeah, that absolutely. Timing of it's important, and then most of the company give you a bit of update on how they're tracking relative to expectations. Now, I tell you what's also really funny, and the investing community always track very closely, is that who has pulled out of the conference ahead of a schedule, ahead of expectations. So there's always a bit of speculation, as to are they going to downgrade and things like that. So that's why this conference is incredibly important. And their trading update and who has attended it, who is not attending, who's changed their mind is becoming very important.
I want to go to some downgrade candidates in a moment, or potential candidates, I guess. But just in the next week or so, we've still got the bulk of US companies report this week and next. How would you describe what we're seeing so far out of company earnings in the US?
Look, so far out of the earnings in US, and things are actually not too bad. Clearly, everyone has downgraded expectations of how things will be, but we heard from the likes of the builders and the like, things are actually better than expected compared to, some of the, doomsayers or what might happen. So things are actually going pretty well. So we do expect that, US may progress through this reporting season actually relatively unscathed. That's why we start seeing our building material companies like the James Hardie started running quite aggressively, just on the back of the, D.R. Horton giving really positive trading feedback and the like. And the Australian market has been cited as one of the strong performers by some of the competitors. So, the reporting season actually is not too bad at the moment from the US players. Now, heading to Macquarie conference that we talked to, our consumer companies, Australia is a slightly different dynamic. We are a little bit slower or a little bit behind compared to the likes of the US. So, it'll be a few months behind. So our retailers are more likely to experience more slowdown than, the likes of what the US retailers are talking about. So, we expect to JB Hi-Fi to talk about more slowdown. Harvey Norman will talk about more slowdown. Any consumer discretionary company will talk about more slowdown because, quite frankly, our consumer hasn't really hit that weak spot yet.
Yeah. Interestingly enough, the so-called consumer sector, or at least the consumer discretionary sector, was the best performing sector in the first quarter. So there was a lot of fear that the consumer was going to be hit pretty hard. To date, the evidence hasn't been there, but you're sensing this might be sort of just around the corner. Is that what you're saying?
Yeah, it's absolutely coming, but so far the feedback is not as bad as what people expect. And so, consumer electronics is not too bad, but what's really slowing down really quickly is housing retailers. So, the likes of Harvey Norman will experiencing much, much tougher trading conditions.
Okay. Well, let's move on to not the JB Hi-Fi, the Macquarie conference, which is at the end of the last couple of days of next week. Just take me through a couple of potential downgrade candidates.
Yeah, so the downgrade candidates we see are more likely to be in the discretionary space, and things like we talked to JB Hi-Fi, things are not too bad, but it is slowing quite quickly. And we're expecting some of the agriculture businesses is going to be a little bit tougher as well. The next few weeks of the banks and the like, I think things are going to be okay, but there is going to be a slower momentum, compared to what the expectations might be in terms of credit growth and everything else. So these are the areas of weakness. I do think that in terms of the housing, the property side, house price is going to slow, and we will have the turnover slowing, but look, I actually think the green shoot is that the turnover, the expectation is that the forward indicator is things are actually going okay. So I do expect those companies to talk to sort of some of the green shoots, even though the current condition might be a little bit tough.
Right. Okay. And we're also going into major bank reporting season. These are the March and September balance date banks. So we've got National Australia Bank, Westpac, ANZ, and of course Macquarie. What do you think we'll learn about the banks when they report? This will happen on the first and second week of May.
Look, I actually think the bank's reporting season will be pretty good, given the underperformance. Some of them have bounced back quite significantly, but given the underperformance, I do think as a sector, they actually will have a pretty good reporting season. As their first half, but the last quarterly result was very, very strong, and then they all warned to this potential slowing in credit growth and then the compression in NIM, and I don't think that's playing through yet in this quarter, in this number, and the share price obviously has been sold off because of the overseas sort of weaknesses, based on some of the the SVB and that sort of regional banks pressure across the world, but I don't think that is apparent in the Australian banks. So I actually think the result will be okay. They may well have a bit of bounce on the back of that reporting season, but the condition is as good as it gets. It's hard to see get any better. So very hard to see share price really sustainably rally any further. But they may well support it, but for the time being, for this reporting season.
Okay, we talked about the Macquarie conference. Let's talk about Macquarie Bank, which I think reports on Friday the 5th of May, so Friday week. Same day as their conference is on. Typically, a bank that surprises on the upside tend to be pretty cautious in their talks to the market, a bit like CSL, like to sort of deliver better than the market's anticipating. It's interesting, it's a stock that's down on the 12 months. It's one of the few stocks that's still down on 12 months. Do you think the market's got Macquarie wrong, or we're likely to see more of a rally into the result and people sort of looking back and saying, oh, we know what happens. They always sort of talk it down a bit, but like to deliver on the upside?
Yeah, the market definitely got this one wrong. I think the result will be very, very strong. I think that it was sold off on the back of the fear of the banking crisis overseas. And this is just really great opportunity. I think it will rally aggressively into the result, and the result will be very strong. So this is the company that we think, with the near term, has a best catalyst within the banking sector, that has a very clear catalyst as well. So result will be strong.
So you're shifting from monies into Macquarie from other banks. Is that sort of how you've been
Yeah, I do think.
trending?
Yeah, absolutely. You're absolutely right. This is the best position. Domestic banks is going to be challenged with, in terms of the credit growth. Things are slowing down. Things are peaking. Whereas Macquarie Bank has so much opportunity in terms of growth. So that's the bank to really stack up really well against everyone else. So I will absolutely be buying into the result, as well as I think the performance will be very, very strong relative to other banks.
Let's shift course. Let's look at technology, and of course, another company that also reports has an August balance date and that's Xero. So it's due to give a sort of a half-year report in the next couple of weeks or so. Was a $150 stock, got down to, I think, might have just got below $70. It's now back at about $90. So I guess you could say it's rallied about 30% from its low. But what's your take on Xero at the moment?
Well, I love it. Look, it's 30% above its low, but it's 40% above what is high. So look, I think this is a company. It's an incredible growth story. Look, people got very worried about the near-term earnings outlook in terms of the UK and economic slowdown things. But remember, this is the company that is taking share. It's not a mature business. It's taking share. It is such a high growth business. And there's so much going for it. Look, it got very cheap. It went to $70 and the like, but that was absolutely buying opportunity. I think the result will be very reasonable. And what's really changed about this business is really its focus on profitability. If it's going to become profitable and just spend a little bit less and become profitable, I think it's it should be trading on the multiple that the WiseTech is trading on. As you know, it's probably more than double or triple what Xero is trading on at the moment in terms of revenue multiple.
So is that the key for sort of growth technology companies? They've got to be, if not profitable, at least cash generative. Is that sort of what the market's not just buying a revenue store anymore? It wants to see the bottom line. But do they need to be making a lot of money, or just being able to sort of pay their way and showing that they're investing sagely?
No, so look, the market do want to see companies that can make money from the existing market. So previously it was revenue multiple, and then it became EBITDA multiple. That's why you see WiseTech has outperformed Xero by something like 40-50%. Now, I think Xero has shifted focus, and they go, you know what, we can be profitable. We're such a fast growing business, and we can be profitable. Just change the expense ratio by marginally, we can be, massively profitable. So I think that's a right way to go, simply because money is becoming a bit more expensive. You need to consider what sort of, risk reward for, investing that capital. Every dollar of capital has its return associated with it. So I think Xero is doing the right thing, and I think it has a far more, massive amount of opportunity in the next 12 months, especially if it's hitting its growth targets.
And what about WiseTech? I mean, it's held up pretty well. It's in fact, it's I guess it's almost higher than it was almost 12 months ago. In sort of June, the bottom of sort of the so-called tech route. It's done very well. Is that? Do you see much more upside in WiseTech, or is that just getting too expensive? It's sort of premature. It's had a lot of acquisitions. The market's paid it. A lot of thinks it's pretty good. What's your view on WiseTech?
No, it's not mature. Look, it's a growth company, and it has rallied a lot. But this is one of the buys in the share market is what they call reference market, reference bias, right? So just because share price was so much smaller, and and today what it is, and you can't invest in it, that's not true. This company has a lot of long runway ahead of it, and what it has demonstrated that is its ability to grow across so many different verticals. And I see enormous amount of opportunity for this company. I think Rickard, CEO Rickard has done incredible job, and he is building a global scale business. If anything, I am a buyer of WiseTech. I think it's a global business.
Okay. Let me finish the interview by talking about the sector or the area you're least interested in at the moment. I mean, because this is that sort of market where Yeah, stock picking sort of coming out. That's sort of a lot of the volatility's gone, but that doesn't mean different parts of the market aren't doing really well. And conversely, there's a lot of underperformance out there. So, where's the area that you're least attracted to at the moment?
Look, I must say, as we touched on before, it is the consumer sector. It's a little bit harder, right? It's very hard to see how a geared consumer can spend any more money compared to what they did in the last few years. They have spent a lot of money. So, that area is very tough. But having said that, I do think that you need to be a little bit selective. Consumer will be very selective with what they
Yeah.
spend. They may not want to spend on movies and or other things that they bought for their houses, but they may still want experiences. Travel is still a big thing because international travel is coming back and the like. So still have to be very, very selective on what consumer is willing to spend on. But clearly, on the purchase of durable goods, I think time is done. They've spent enough money on it. That's time to go short. And what they want is really, as consumer, is really experiences.
Okay. All right. We might leave it there. That's Jun Bei Liu from Tribeca. Thanks for joining us on Switzer.
Thank you for having me. Thank you.
That was Jun Bei Liu from Tribeca. My next guest is Wong from Prime Value. He's the Chief Investment Officer. And he's particularly keen about the insurance sector and three companies in different parts of that market. Joining me now is Wong from Prime Value. Are you sort of worried about the market at the moment? We're not a lot of progress. We've been a little bit higher following the US up, but not really a lot of momentum one way or the other, is there?
Yeah, we're kind of in a twilight zone, if I could put it that way, Paul, in the sense that, markets have had a big run the last couple of months. Rates seem to be peaking, perhaps one or two more to go. But at the same time, the market's kind of waiting on the reporting season or result season the next couple of weeks from the US. So it's kind of in a stable but somewhat expectations have risen in the market. So as a result, I'm sitting back and kind of looking back, looking forward as well, and sensing that perhaps I should be somewhat cautious at this point.
There's sort of increasing sort of talk of possibly of rate cuts late this year, early next year in both the US and Australia. Do you buy that scenario?
Yeah, look, it's a tough one to dissect. On one hand, we think that rates will continue to rise, but at the same time, staying elevated. The rate cut scenario that's yet to play out. I think we still have to wait for a bit more data points from the US to see how that pans out. But my base case scenario is that rates will stay reasonably elevated into the second and third quarters of this calendar year. And that's pretty much my playbook. Whether rates will come through in terms of cuts by, say, the fourth quarter of this calendar year or into first quarter of next year, I'm kind of tentative on that, but certainly not dismissing that scenario.
Okay, let's talk about a sector I think that you like. You think mainly because it's got pretty resilient earnings. It should be a beneficiary of both higher interest rates and potentially, I guess, inflation because of pricing power. And that's the insurance sector. Tell me, why is the insurance sector sort of way up there on your sort of list of places to invest at the moment?
Sure, Paul. Look, I think the insurance sector in Australia is quite interesting. Not only is there value in some of the stocks that we hold, but I think predominantly we're looking for companies which are going to be resilient in terms of earnings through the economic cycle. And we're kind of finding this in the insurance sector in Australia. So if I could put it in one sentence, I'm really looking for toll booth type companies. And this fits, the insurance sector kind of fits the bill of what I term as toll booth companies. So the holdings that we have, example, Austbrokers or AUB Group, which is an insurance broking business. It takes a clip on any insurance that passes through its books. But also we have holdings in QB Group, which is the global insurer, but also in NIB Holdings, which is a healthcare insurance companies. But predominantly it really fits our criteria, what we're looking for, which are toll booth companies. They take a clip on the business transaction. and we think the insurance sector really fits that bill at this point.
I know the insurance companies generally have been able to increase margin, but that's come, I guess, because the claims experience has been on the high side by historical standards the last couple of years. But one of the reasons that people put that down to is sort of, I guess, maybe a little bit too early, but the impacts of climate change or potentially, more, sort of natural hazard risk. So is that something that sort of rings alarm bells for you when looking at insurance companies?
Yes, Paul, that directly hits the point for insurance companies, which is why I'm avoiding companies such as Suncorp and IAG,
Right.
which has got a direct exposure to that. Whereas in the case of NIB insurance, it is health insurance, and the claims factor is probably not as punishing as what we're seeing through climate change impacting the likes of IAG and Suncorp, which is exposed to a lot of property type exposures. So NIB insurance, I think, kind of reduces our risk in that area, primarily because it is due to health insurance. It is really short tail, and we get a good sense of how insurance do track. And the good thing about health insurance is that we're actually seeing margins expand in this sector because claims continue to, I guess, come in lower than expected. So that's really a key point for NIB.
There have been concerns when I look at health insurance about potentially declining or so-called declining participation rates in actually taking out health insurance. That trend is sort of stopped a little bit, but is that something, again, that it's one of those issues you've just got to weigh up when you invest in a company like NIB or potentially its competitor Medibank?
Yes, absolutely, Paul. That was a major concern going into COVID, and which is one of the reasons why I had not invested in the likes of Medibank or Medibank Private and NIB, and concerns that the take-up ratio, the penetration of private insurance kind of was slipping. Yeah. And policyholders were actually dumping their insurance policies riding into COVID. But when COVID hit, this changed. So private health insurance participation actually rose and continues to rise. And that pattern continues to be quite resilient. So the top line picture for groups such as NIB and Medibank Private has actually been really robust. And as a backup to that is that with the reopening of the Australian borders to international students and tourism as well, the travel insurance sector, which is really health related, has also been coming back to the market. And these are high margin businesses, which will benefit the likes of NIB and Medibank Private as well. So top line revenue growth profile, the concerns have probably been reversed by COVID, and consumers like you and me are actually retaining private health insurance in a much larger way than pre-COVID. Going back to the top line again, where insurance premiums is concerned, now wages are tracking about 3 to 4% rises per annum, probably in the next 2 years. And what we'll find is that the insurance premium cycle will probably come in below that. So it's going to come in below where the wage cycle is. So that's a relative positive.
Okay. Well, I guess going back to that sort of explains a bit about NIB, but let's talk about QB, which, as you say, is a global insurer with big business in Australia, but it's very well a lot of operations right across many other parts of Europe and South America and other countries. Just sort of, isn't QB in some way exposed to sort of the climate change issue, or is it able to be able to diversify its book so that it's got, I guess, insurance product lines that aren't as exposed to natural hazard risk?
Yeah, look, let me put it in context, Paul, is that I have looked at QB for about 15 years, but I've only started investing in QB about 6 to 9 months ago. And that's because we've taken so much time to become comfortable with a company like QB because it is complex. It's a company which has been built on acquisitions, and as a result, trying to understand the business has been difficult. But what's happened with QB in the last 18 to 24 months is that we've had a new CEO come in, and the business is being de-risked. non-core businesses are being sold. And QB today, it's a much simpler and less riskier business than where it was, say, 3 to 5 years ago. So we're benefiting from that de-risking exercise that the new CEO is coming in and bringing into QB. So that's one aspect of QB as to why we're investing into QB. The second aspect is that despite the talk about claims rising, premiums for QB has been rising for the last 5 to 7 years annually. And the good thing about insurance is that these premiums typically compound. So we're compounding 5% on 5% on 5% growth per annum on the top line growth. It becomes quite a meaningful business or pool of revenues, premiums when you build that out the last 5 to 7 years. So we're getting that benefit from a top line perspective as well. And as a result, we think that margins will actually benefit QB going forwards. The final thing about QB is that it is a company which is trading about 9 to 10 times earnings. And that's really hard to find in this marketplace. So a company with decent valuation, good earnings prospect growth in the next 2 to 3 years, risk coming off as well. So we think QB is actually a company which will be re-rated for the next couple of years. So that's really the premise of why we're buying QB, and it kind of overrides some of the risks it does have on its books. For example, as we talk about climate risk and claims rising as a result of, climate change effectively.
Do you have a price target on QBE, SD?
Look, the stock is trading about $15 today, which is about 10 times earnings. It's not inconceivable. This company trades about 12 to 13 times. So, kind of multiple of 20, 30% from where it's trading at today, which is about just above $15 today.
Okay. And of course, Oslock would be even cheaper, right? Because it's sort of a small cap. What are you sort of thinking about Oslock?
Osbrokers, look,
it's
probably on the high side where valuation is concerned. It's trading about $27.40 today, just this morning. Look, we think that the earnings growth is going to be pretty strong next couple of years on two accounts. One, the insurance premium cycle continues to be very positive for the company, but also it made a large acquisition in the UK, a company called Tysers, which we think the synergies will be driving earnings in the next couple of years. So, to expect a 15 to 20% return from where it sits today, about $17.20, $17.40, that's probably a reasonable target to expect for a company like AUB or AUB Group.
Well, thank you for sharing those thoughts about NIB, QBE, and Osbrokers. Great ideas, and certainly a sector worth looking at. Thanks for your time, ST.
Great, thanks, Paul.
That was ST Wong from Prime Financial. That's all for this week. Peter will be back, of course, next Monday. And don't forget our Switzer's report out today, and of course our Thursday edition with Tony Featherston. I'll see you again soon. I'm Paul Rickard.